Underlying profit up 21%, reported profit down 72%. SingTel reported a headline net profit decline of 72% for the first quarter, but reading that as a business collapse is completely mistaken. Underneath that accounting drop, underlying net profit actually grew 21% year-on-year. I'm Iggy, I run the numbers on SGX stocks, so retirees don't have to guess whether a scary headline actually means trouble. Seeing a massive headline drop alongside a 21% operational jump means the market is looking at two completely different realities. And our job is to separate one-off accounting comparisons from the recurring cash flows that actually fund dividends. Let's walk through the numbers. The headline fell 72%. If you saw that alert on your brokerage app and assumed SingTel had run into an operational wall, you'd be misinterpreting the quarter entirely. The core operating business beneath that paper number expanded. When you strip away the high base effect from previous asset sales, the underlying engine was generating more operating profit than it did 12 months ago. Why this quarter deserves a closer look? This quarter demands a careful look whether you currently hold the shares or are waiting for an entry point. For existing holders, a 72% drop sounds alarming for a retirement portfolio, but the cash generation behind it did not deteriorate. For those watching from the sidelines, understanding why headline accounting numbers diverge from operating earnings is essential before committing capital. Most importantly, this quarter does not move the governing yield verdict because the interim dividend decision only lands with the half-year numbers in November. The number that looks bad and why it isn't. Reported net profit landed at 818 million Singapore dollars, down 71.6% on a reported basis and 70.1% in constant currency. That decline is almost entirely due to a high comparison base. The same quarter last year included a 2.2 billion Singapore dollar exceptional gain from the partial stake sale in Bhakti Airtel and the InTouch Gulf Energy merger. This quarter had a minor net exceptional loss of 12 million Singapore dollars instead. Remove exceptionals from both periods, and the underlying business grew. What actually grew? Underlying net profit, the specific pool of recurring earnings from which SingTel pays its core ordinary dividends, rose 21% year-on-year to 831 million Singapore dollars or 27.3% in constant currency terms. Part of that boost came from net finance income swinging from an $86 million net expense last year to $38 million of net income, driven by a first-time 153 million Singapore dollar dividend received from Gulf Development following the June divestment. Stripping out the one-off, still roughly 15% growth. Even treating that Gulf dividend as a one-off and stripping it out completely, underlying net profit still grew by around 15%. Operating company EBIT rose 10.4% to 462 million Singapore dollars, already tracking ahead of full-year guidance of low to mid-single-digit growth. Group EBITDA rose 8.7% to $1,076 million, with margins expanding to 30.2%. Operating revenue grew 4.9% to 3,558 million Singapore dollars, though constant currency revenue was roughly flat at just 0.4%. Regional associates carried real weight. The regional associates delivered substantial earnings momentum this quarter, with post-tax profit contributions rising 16% to 543 million Singapore dollars, or 26% in constant currency. That performance was not evenly distributed. The primary heavy lifting came from Airtel Africa, where profit jumped 51% on double-digit revenue growth across every segment, and AIS in Thailand, which grew 33% to $134 million, cementing its position as SingTel's second-largest regional associate by profit. Associate detail: India, Telecom and Globe. Airtel India and South Asia grew 11% to 254 million Singapore dollars, supported by a 5.4% increase in mobile ARPU and record postpaid additions. In Indonesia, Telkomsel grew 2% to 117 million Singapore dollars on higher mobile ARPU, which helped offset soft fixed broadband revenue. In the Philippines, Globe fell 9% on a reported basis to 54 million Singapore dollars as higher depreciation and finance charges offset otherwise steady data growth. Bhakti Telecom and the currency drag. Bhakti Telecom's reported net loss narrowed to 60 million Singapore dollars, but that improvement was helped by currency translation. In constant currency terms, the loss actually widened due to increased debt servicing and higher finance costs. Across the broader group, the persistent strength of the Singapore dollar created an adverse currency drag of roughly 46 million Singapore dollars, muting what would have otherwise been an even stronger constant currency profit performance from the overseas units. As Optus, real margin improvement flattered revenue. In Australia, Optus reported revenue of 1,789 million Singapore dollars, up 6.6%. that reported top line was flattered by the Australian dollar strengthening 9% against the Singapore dollar. In constant currency, Optus revenue actually contracted 2.2% on weaker handset sales. Mobile service revenue rose 3.3% from price increases, lifting EBIT by 14% and EBITDA by 14.5%. The operational margin improvement at Optus is genuine, not a currency effect. Singapore core telco, a less flattering tale. The domestic core telco business in Singapore presents a much tougher operating environment. Operating revenue fell 3.1% to 901 million Singapore dollars amid intense price competition. Mobile service revenue dropped 4% as blended mobile ARPU slid to $22 a month from $23 a year ago. Domestic EBITDA fell 4.6%. EBIT declined a smaller 2.2%, but that was driven by lower depreciation from a depreciated asset base, not an operational gain. The two growth engines. Outside legacy connectivity, SingTel's two dedicated growth engines generated strong numbers. NCS expanded revenue 9.7% to 804 million Singapore dollars, with EBIT surging 29% to $102 million on strong enterprise demand for digital resilience, securing $860 million in new bookings. Digital Infra grew revenue 19% to $127 million and EBIT 10% to $26 million. Powered by the Exera Tuas data center and ongoing AI infrastructure commercialization. One open item worth flagging. There's a material disclosure in the subsequent events note that doesn't appear on the summary slides. On the 30th of July 2026, the Australian Communications and Media Authority initiated federal court proceedings against Optus regarding a September 2025 network outage that affected emergency service calls. Potential financial liabilities cannot be reliably estimated at this stage, but it's an active regulatory and legal exposure inside Optus worth tracking independently of anything in this quarter's operating numbers. A headline number and an operating result are not the same thing. The most dangerous habit when reviewing quarterly updates is treating the boldest headline number as the entire operational story. The 72% net profit decline is real and accurately reported, but it's almost entirely an artifact of last year's $2.2 billion divestment gain. Underlying profit up 21% and OpCo EBIT running ahead of full-year targets show a business executing well. Reading only the headline leads directly to the wrong conclusion. Asset recycling, past 75% of the $9 billion target. SingTel's capital management program continues to execute on schedule. The group has surpassed 75% of its midterm 9 billion Singapore dollar asset recycling target, having raised roughly $6.8 billion to date, aided by the $1 billion Gulf stake sale. On capital return, the company has deployed 41% of its $2 billion share buyback program, cancelling $819 million of shares, an estimated 1.1% accretion to earnings per share. Value realization dividend, named precisely. The value realization dividend program is structured to distribute up to 5 billion Singapore dollars through FY30, paying 3 to 6 cents per share annually, funded directly by asset recycling proceeds. Roughly $1.7 billion has been paid out so far, alongside the already declared FY 2026 final VRD of 3.3 cents. It's worth separating this asset monetization payout from the recurring ordinary dividend when assessing the sustainable income yield of the stock. Engineered yield policy, VRD excluded. Under our standing engineered yield policy, the value realization dividend is excluded from SingTel's governing yield calculation. Special dividends funded by selling corporate assets don't represent organic cash flow from core business operations. Alongside the dividend, the value realization share buyback has committed roughly $1 billion, with up to $1.2 billion remaining through FY 2028. Disciplined capital return is positive, but it doesn't count as ongoing organic dividend yield. A rising capital return program is not the same as a rising governing yield. It's tempting to see asset recycling passing 75%, buybacks providing EPS accretion, and special dividends flowing out, and assume the income case has strengthened. For SingTel specifically, that assumption doesn't follow. Capital management execution is sound discipline, but our governing yield is strictly anchored on organic ordinary dividends alone. A well-executed asset disposal program doesn't automatically turn a stock into a qualifying high-yield retirement anchor. Before the verdict, everything so far has been about what changed this quarter. What hasn't changed is the actual question that decides whether this stock clears the bar for retirement income. Let's get to that now. What this means for the zone verdict. SingTel doesn't declare dividends during first quarter updates. The interim dividend announcement happens alongside the first half results scheduled for November 2026. Consequently, SingTel remains classified in Zone 4-, unchanged from our late July review, that upcoming November print, where management confirms the next ordinary distribution, is the only event that can formally move the governing yield calculation. The standing verdict, a wide miss. SingTel's trailing organic ordinary yield stands at 3.03%, which misses our 4.7% forensic hurdle by 167 basis points. It also trades below the 4.0% floor offered by CPF special account. A wide margin shortfall like this is what earns the minus suffix on its own. A reader with a longer runway before drawing on retirement savings may reasonably choose to wait for November to see if dividend growth narrows that gap. How the framework is calibrated. Readers holding capital surplus to basic retirement living expenses may decide to apply a different standard, accepting a lower initial yield in exchange for regional growth exposure. But within this framework, a Zone 4 verdict is a timing gate, not a permanent rejection. The 4.7% hurdle is calibrated against the most resilient risk-free Singapore dollar option in the financial system, to make sure retail investors are properly compensated for taking on equity risk. One item still unresolved. One balance sheet question remains unresolved in this update. The previously flagged net debt to EBITDA methodology discrepancy, roughly 1.3 times on one reporting basis versus 3.1 to 3.4 times on an expanded basis, isn't reconciled here. This is a high-level quarterly business update, not a full financial statement release, so we wait for the November balance sheet to audit debt ratios properly. A good quarter. This was a fundamentally solid operational quarter for SingTel, and existing shareholders should be encouraged by the steady performance of NCS, Digital Infra and the regional associates. Strong underlying execution doesn't change the fundamental question of whether a fresh buyer today is receiving enough organic yield to justify the equity risk. That question stays open until November. Summary: what this quarter tells us. Underlying operations showed real strength, asset recycling is advancing ahead of plan, and the accounting profit collapse is purely a comparison distortion. For disciplined income investors, the governing yield verdict remains on hold until the half-year numbers are delivered. Get everything zero-day access on both platforms, our full Red Zone watchlist, and institutional-grade cheat sheets. Join Iggy's elite investors for 12 Singapore dollars a month. Iggy's forensic disclaimer: this content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.